Have you ever wondered what are the best ways to invest $1,000 in 2024? Well, wonder no more. We're about to explore the top 5 investment options that could potentially give your money a boost. Now remember, the financial market is a fickle beast. While these options are generally regarded as smart choices by financial experts, they're not guaranteed to provide returns. They do, however, offer a chance to grow your wealth, and perhaps more importantly, get you into the habit of investing wisely. You'll find options that cater to different risk tolerances and investment philosophies, from the relatively safe and steady to the more volatile and potentially rewarding. Whether you're a seasoned investor looking for fresh ideas or a newbie wanting to dip your toes into the investment world, this guide could be just what you need. So, without further ado, let's dive into the top 5 ways to invest $1,000 in 2024. Starting at number 5, we have peer-to-peer lending. Peer-to-peer lending, often referred to as P2P, is a unique concept that has rapidly gained popularity in recent years. Rather than borrowing from traditional financial institutions, P2P lending allows individuals to borrow and lend money directly to each other. It's a bit like a financial matchmaker, connecting people who need money with those who have it to spare. The process is fairly straightforward. Lenders put their money into a P2P lending platform, where it's divided into small chunks to fund multiple loans. Borrowers then apply for these loans, and if approved, they receive the funds and repay them over time with interest. The interest paid by the borrowers is then divided among the lenders, providing them with a return on their investment. But why should you consider P2P lending as an investment option? Well, it's all about the potential for high returns. The average interest rates on P2P loans tend to be higher than those of traditional bank loans, meaning lenders can potentially earn more on their investment. It's a great way to diversify your investment portfolio and put your money to work in a unique and exciting way. However, like any investment, P2P lending does come with its fair share of risks. The most obvious one is the risk of default. If a borrower fails to repay their loan, the lender could potentially lose their investment. It's also worth noting that P2P lending platforms are not covered by the Federal Deposit Insurance Corporation, meaning your money isn't insured in the event of platform failure. Despite these risks, many investors find P2P lending to be a rewarding investment. It gives them a chance to earn a decent return while also helping others achieve their financial goals. It's a win-win situation, really. In the end, P2P lending might not be for everyone. It requires a certain amount of risk tolerance and a willingness to venture outside the traditional investment box. But for those who are willing to take the plunge, it can be a lucrative way to grow their wealth. While peer-to-peer lending can be a bit risky, it can also yield high returns when done right. Coming in at number 4, we have exchange-traded funds, or ETFs. Now let's unravel the mystery behind these 3 letters. An ETF is a type of security that involves a collection of securities, such as stocks, that often aim to track a specific index. However, the beauty of ETFs is that they can invest in any number of industry sectors, or use various strategies, providing a rainbow of options for investors. Picture an ETF as a basket. This basket can contain a variety of different fruits, or in this case, different types of investments like stocks, bonds, or commodities. This diversity is one of the reasons why ETFs are a popular choice among investors. The variety within the basket helps to spread the risk and can potentially increase your chances of a tasty return. Another reason why ETFs are a favorite amongst investors is their accessibility. ETFs are traded on exchanges, just like individual stocks, and can be bought and sold throughout the trading day at fluctuating prices. This means you have the ability to jump in or out of the market whenever you see fit, providing a level of flexibility that mutual funds, for example, can't offer. But let's not forget to consider the potential drawbacks. While ETFs generally offer lower expense ratios than mutual funds, they are not immune to fees. You'll need to keep an eye on commission fees from buying and selling, as these can eat into your returns. Additionally, while the diversity within an ETF can spread risk, it doesn't eliminate it. The value of your ETFs can go down as well as up, depending on the performance of the underlying securities. Despite these potential drawbacks, ETFs have their shine. They offer diversity, flexibility, and accessibility, making them an attractive choice for both seasoned and novice investors. Whether you're looking to dip your toes into investing or diversify your portfolio, ETFs could be a solid choice for your hard-earned $1,000. After all, Who doesn't like a basket full of diverse investment fruits? ETFs offer a balanced approach to investing, making them a solid choice for your $1,000. At number 3, we have real estate crowdfunding. Real estate crowdfunding is a modern twist on a classic investment strategy. You're probably familiar with crowdfunding, where a group of people pool their resources to fund a project or venture. Real estate crowdfunding applies this same principle to property investment. It's a way of democratizing the real estate market, allowing everyday individuals to invest in property without needing the massive capital usually required. Here's how it works. A real estate developer or company will list a project on a crowdfunding platform. Then, investors like you and me can buy shares or stakes in that project. This can range from residential properties, commercial buildings, to large-scale developments. Once the project is complete and starts generating revenue, you receive a proportionate return on your investment. Now, why is this an attractive investment? Well, real estate has historically been a stable and lucrative asset class. It's tangible, it's necessary, and in many markets, it's appreciating. By crowdfunding, you get a slice of this pie without having to manage the property yourself. Plus, the minimum investment is often much lower than buying a property outright, making it more accessible. But, as with any investment, there are risks. Real estate markets can fluctuate, and the success of a project can depend heavily on the expertise of the developer. There's also the risk of a project failing or running over budget. And unlike stocks or bonds, it's not as easy to sell your stake if you need to liquidate your investment quickly. However, many platforms offer a level of vetting for their projects, and some even provide secondary markets where you can sell your stake. So, with careful research and due diligence, these risks can be managed. Real estate crowdfunding can be a great way to get involved in property investment without needing a fortune. It's a chance to diversify your portfolio and tap into the power of the property market. Remember, the key is to understand what you're investing in, scrutinize the potential risks, and, as always, never invest more than you're willing to lose. Our runner-up investment option for 2024 is cryptocurrency. Cryptocurrency, a digital or virtual currency, has taken the world by storm. It uses cryptography for security, making it difficult to counterfeit. The allure of cryptocurrency is rooted in its potential for high returns. In recent years, there have been stories of people becoming overnight millionaires due to the sharp increase in the value of certain cryptocurrencies. However, it's not all sunshine and rainbows. Cryptocurrency is notorious for its volatility. Prices can skyrocket one moment and plummet the next. This high-risk, high-reward nature makes it a thrilling, albeit nerve-wracking option for investors. But what makes investing in cryptocurrency in 2024 so attractive? Well, it's the prospect of getting in early on the next Bitcoin or Ethereum. These two cryptocurrencies have shown what's possible when the right ingredients mix. Furthermore, with the increasing acceptance of cryptocurrencies by mainstream businesses and the potential for blockchain technology, there's a lot to be optimistic about. Yet it's crucial to remember that investing in cryptocurrency isn't for the faint of heart. It requires a good deal of research, understanding of the market, and most importantly, a willingness to withstand significant financial swings. For those who can stomach the risk, the potential rewards are enormous. But as with any investment, it's essential to never invest more than you can afford to lose. Despite its volatility, cryptocurrency continues to be a popular and potentially profitable investment. And finally, our top pick for the best way to invest $1,000 in 2024 is index funds. So, what are index funds? At their core, they are a type of mutual fund with a portfolio constructed to match or track the components of a financial market index. This means they provide broad market exposure, low operating expenses, and low portfolio turnover. They are designed to mimic the performance of a specific market index. But why are they such a good investment choice? Well, their beauty lies in their simplicity and efficiency. They offer diversification, which means you're spreading your investment across a wide range of assets, thus reducing risk. They are also passively managed. This means they aim to replicate market indices, not beat them. As a result, they often have lower fees than actively managed funds, and this can significantly enhance returns over the long term. The potential for steady growth is another compelling reason to consider index funds. They have a long track record of solid performance, and while they may not offer the explosive growth of some riskier investments, they provide a more predictable and steady return. However, like all investments, index funds come with their own set of potential disadvantages. They're subject to market risk, meaning if the market takes a downturn, so will your investment. For a solid long-term investment, you can't go wrong with index funds. And there you have it. The top 5 ways to invest $1,000 in 2024. We've journeyed through the world of peer-to-peer lending, where you can become a mini bank, lending your money to others for a return. We've discovered the diverse realm of exchange-traded funds, bringing you a broad exposure to a variety of markets. We've plunged into the exciting universe of real estate crowdfunding, allowing you to own a piece of the property market without needing deep pockets. We've explored the volatile but potentially rewarding landscape of cryptocurrency. And finally, we've landed on the tried and true territory of index funds, a favorite for many investors. Each of these options has its own set of advantages, risks, and potential returns. It's essential to remember that while these are generally considered smart choices, you should always do your own research before making any investment decisions. Remember, the best investment is the one that aligns with your financial goals and risk tolerance. Happy investing.